Something absolutely massive just went down in the financial world, and it's like nobody even saw it happen. We are about to follow the money, a $2 trillion trail, and trust me, it could change, well, pretty much everything.
Okay, just let this number sink in for a second. 2 trillion euros. That is a 2 followed by 12 zeros. This isn't some analyst's wild guess or a forecast for the future. No, this is real, hard cash that just got moved.
And you want to know who moved it? BlackRock. Yeah, only the biggest asset manager on the entire planet. And the craziest part? They did it silently. No press releases, no big announcements, nothing. This wasn't some rumor you'd see trending on Twitter. This was a quiet, calculated, global chess move with trillions of dollars.
So that brings us to the billion-dollar, or I guess the $2 trillion question, right? Where is all this money going? And maybe even more important, why now? Because if we can figure that out, we get a roadmap to where the next big wave of wealth is really going to be made.
All right, so let's start with part 1. Before we can track the money, we have to appreciate the scale of the player moving the pieces. And when we talk about BlackRock, well, they're not just a big fish in the pond. They pretty much are the pond.
I mean, look at this. BlackRock isn't your average Wall Street firm. We're talking about a company controlling over $14 trillion. That's more than the GDP of most countries. They are a top shareholder in basically every company you've ever heard of, from Apple to Amazon. So you got to understand, when they move their money, it's not a speculative bet. It's a very, very loud signal.
And this really gets to the heart of the matter. It's the difference between institutional smart money and, well, the rest of us. We, the retail investors, are reactive. We see a scary headline and we sell. We see good news and we buy. But them, they're proactive. They position their money based on data before the news ever breaks. By the time we're reading the headline, they've already cashed in.
Okay, on to part 2. This is the big why. I mean, for the last decade, the U.S. market has been the place to be, right? So why on earth is the biggest player on the field suddenly looking elsewhere? Let's get into it.
It really comes down to 3 core things. First, the US dollar is getting weaker. Second, there's a massive, and I mean massive, performance gap opening up. And third, there's this incredible thing called the double gain opportunity.
And this chart just lays it all out plain as day. Look, in 2025, the S&P 500, a 16% return. Hey, that's great. Nobody's going to complain about 16%. But look what you missed out on. International markets did 24%, and emerging markets, a whopping 30%. That's almost double. By staying only in the US, you're leaving a huge chunk of potential profit on the table.
And this is that double gain I was talking about. This is where it gets really juicy. Think about it. When you invest overseas and the US dollar gets weaker, you win 2 ways. First, your investment hopefully goes up in value. Great. But then, when you bring those profits back home, you're converting them into a weaker dollar, which means you get more dollars back. It's like hitting a home run and getting extra bases for free. It's a massive tailwind.
So, part 3. Where are the new hotspots? Where is this river of cash actually flowing? Well, we can actually see the tracks. We can look at a few key ETFs, those baskets of stocks, and they act like a treasure map, showing us exactly where the smart money is going.
First on the map, hotspot number 1 is an ETF called VWO. This is your ticket to emerging markets, places like China, India, Brazil. And the story here isn't just about factories, it's about people. The average age in India is 28. 28. In the US, it's 48. A young population is a consuming population, and that drives growth for decades. And here's the secret sauce. Institutions love to buy this stuff when it's going sideways, when it's boring, and everyone else has forgotten about it.
Okay, hotspot number 2. We're looking at the ETF for Japan, EWJ. And I can already hear you thinking, Japan? Really? What about their lost decades? And yeah, Japan is part of the story, but the real institutional focus, the place the truly massive money is sneaking into, is a bit of a surprise.
They're laser-focused on Italy. Yes, Italy. Why? Well, a few things are happening. There's a quiet revolution going on where companies are finally being forced to prioritize profits for shareholders. Plus, the weaker euro means iconic brands like Ferrari and Stellantis are selling like crazy overseas. It's a huge turnaround story, and the big money is getting in early.
And for hotspot number 3, we've got EEM. Think of this one as the all-star team of emerging markets.
It wraps up all those fast-growing economies into one easy package. And I mean, just look at that number. A 44% return in 2025. That's not a signal. That's a foghorn blasting that the smart money believes the rest of the world is where the action is.
All right, so while all this is happening with stocks, there's another major shift going on in the background, and it involves gold. But this isn't about the price of gold going up or down. No, this is much bigger. It's about a fundamental rule change in how the entire global financial system views gold.
So under these new banking rules called Basel III, gold just got a major promotion. For years, banks treated gold like it was just a shiny rock in the basement, a Tier 3 asset. But now, it's been reclassified as a Tier 1 asset. That puts it on the same level as cold hard cash. What does that mean? It means banks can now use their gold reserves as real capital, to make loans, to create leverage. Gold went from being a paperweight to being a power tool.
Okay, part 5. We know where the money's going, but to really get inside the mind of these big players, we have to talk about something else: fear. Because fear is the one thing they use to their advantage, and it's the very thing that trips up almost everyone else.
And history proves this over and over again. The best moments to make life-changing money are always the scariest. Think about 2009, the depths of the financial crisis. The world felt like it was ending. And that's exactly when you could have made 400% gains over the next decade. Or remember March 2020, total panic. The world is shutting down. If you bought then, you doubled your money in a year and a half. The playbook is always the same. Maximum fear creates maximum opportunity.
And this quote just nails it. Certainty arrives only when the returns are already gone. If you're waiting for the news to tell you it's safe to invest, you've already missed the boat. You're buying the top. That all-clear signal is the most expensive thing you can wait for in the market.
Okay, so here we are, part 6. We've seen what the big guys are doing, so what does this mean for you, for me? How do we actually use this information? Let's put it all together into a game plan.
It's all about thinking like they do. And step 1 is just understanding that the game is changing. Market leadership is rotating away from the US for a while. Now, step 2, and this is crucial, is don't panic. This isn't about selling everything. It's about smart diversification. And step 3, stop trying to predict the future. Just follow the clues, follow the $2 trillion footprints. And finally, step 4, get in position, and then just be patient. Let it work. So, look, BlackRock has made its move. They've shifted $2 trillion based on where they see the future heading. So now the question comes back to you. Are you going to follow the tracks, or are you going to stay put, hoping yesterday's game plan still works tomorrow?